Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of the corporate world so you don't have to. Today we are diving into a report that is all about a company called Plymouth Industrial REIT Incorporated, and it looks like they are letting us in on some recent legal troubles and how they are trying to move past them. This is a current report filed with the Securities and Exchange Commission, or SEC, which means it's about something important that just happened or is happening with the company, and usually these reports are filed when there are major changes or events. The earliest event reported here is the 12th of January 2026, so we are looking at the very latest information. Plymouth Industrial REIT Incorporated is the company in focus. They are in the business of owning and managing industrial real estate. Think warehouses, distribution centers, that sort of thing. Their common stock trades on the New York Stock Exchange under the ticker symbol Plymouth, as it is often called, is currently in the middle of a big deal, a merger. This report is under the Other Events section, which usually means there isn't one specific category that fits what they need to report. It's for things that are important but don't fit neatly into other predefined sections. So the big news here is about a merger agreement that was previously announced. This agreement is with several other entities to combine Plymouth Industrial REIT Incorporated and its operating partnership. Basically, the company is being bought out or merging with another entity. This is a pretty standard, though still significant, event for a publicly traded company. They had a special meeting scheduled for the 22nd of January 2026 for their stockholders to vote on this merger. This is where shareholders get to have their say on whether this big transaction should go through. Now, here is where it gets interesting. It seems like not everyone is happy about the disclosures related to this merger. The company mentions receiving 10 demand letters and having 2 lawsuits filed against them by shareholders. These lawsuits are claiming that the information provided to shareholders about the merger wasn't complete or accurate enough. This is a common occurrence when big deals like this happen, as shareholders want to make sure they are getting all the important details before they vote. Plymouth's stance is that these claims are not valid. They believe they have not violated any laws, and that their disclosures are correct. Even though they think they are in the right, they are choosing to add some extra information to their official proxy statement. They are doing this to avoid the hassle, cost, and potential delays that come with these kinds of lawsuits. It's a strategic move to keep the merger process smooth. They are essentially saying, we don't think we have to do this, but to move forward without more trouble. Here is some extra detail. These new disclosures are meant to supplement what was already provided. Think of it like adding an appendix to a book that clarifies a few points. The report then goes into specific changes being made to the proxy statement. For example, it details the timing of when a confidentiality agreement was sent out regarding a potential partner, referred to here as Party A. This agreement had a clause that allowed Party A to make confidential offers, unless those offers would require a public announcement. It also had a called Don't Ask, Don't Waive clause, which usually means if you don't ask for something, it is assumed you will not be granted it. And this agreement would end if Plymouth found another buyer. Similarly, they are adding details about a confidentiality agreement with someone called Macarora. This agreement also contains similar terms, including the standstill provision and the termination clause based on a third-party acquisition. To raise also an update regarding a Party B NDA, with discussions and execution dates being clarified. It seems like the company is being very precise about the timelines and terms of these agreements to address the shareholders' concerns. This part reiterates that the board of directors unanimously approved the merger agreement and recommended it to shareholders. This is standard procedure, but it's included to show that the board is confident in the deal. An interesting point here is that when the merger agreement was signed, there were no discussions about future jobs for the company's management with the companies involved in the merger, Macarora and Ares. This is often a point of concern for shareholders, as management might be incentivized to approve a deal if they get lucrative post-merger positions. So, the company is clarifying that this was not the case here. They are also amending the number of parties they contacted during their go-shop period, which is a time when they actively sought out other potential buyers. It seems like they first said 13 parties, but now they are correcting it to 12 parties with whom confidentiality agreements were signed. They also note that none of these new agreements included a standstill clause, which typically prevents a party from trying to buy the company through other means. Now, let's look at some of the financial details. This section delves into the financial projections that were used in analyzing the deal. Specifically, it shows projected unlevered free cash flow. This unlevered free cash flow is essentially the cash a company generates that is available to all investors, both debt and equity holders, after all necessary operating expenses and investments are paid for. But before any debt payments, they show projections for the next 6 years. For year 1, they project $104.2 million. Increasing to $124.0 million by year 6, While these are projections, they give us an idea of the company's expected future cash generating ability. This section talks about a discounted cash flow analysis, which is a way to figure out what a company is worth today based on the cash it is expected to generate in the future. They are estimating the value of an investment called the ISOC's JV, and assuming it will be sold in the 6th year. They have calculated a portion of the sale value for Plymouth as $42.6 million. Here we see a comparable public companies analysis. This is where the investment bank looks at similar companies that are already publicly traded to see what their valuations are. They compare things like enterprise value, which is the total value of a company, and multiples like price to funds from operations or P/FO. They list Stag Industrial Incorporated and LXP Industrial Trust as comparable companies. For Stag, the enterprise value is listed as $10,504.3 million. With a P/FO multiple for 2025 pegged at 15.4x. LXP Industrial Trust has an enterprise value of $4,459.0 million and a P/FO 2025 EFA multiple of 15.0x. This helps them understand what the market is valuing similar industrial REITs at. This is a net asset value analysis. It is basically trying to figure out what the company would be worth if you valued all its individual assets and then subtracted its liabilities. They're arriving at an implied share price range of $19.92 to $22.97. This is compared to the merger consideration of $22 per S-share. This is a premiums paid analysis table. It looks at a history of acquisitions of similar companies and shows the premium paid over the stock price before the announcement. For example, MedEquities Realty Trust Incorporated saw a 50.0% premium paid 1 day prior to its announcement. These numbers help justify the price being paid for Plymouth. This section presents JP Morgan Securities, LLC's opinion. They're looking at public trading multiples analysis. They're comparing Plymouth's multiples to those of Stag Industrial, Incorporated and LXP Industrial Trust. Plymouth's PCI 2025 EFFO multiple is shown as 7.6x, while Stag is at 15.4x and LXP is at 15.0x. This highlights that Plymouth, based on this metric, is trading at a lower valuation compared to its peers. This is a key number that often influences merger discussions. They derived a range of implied per-share equity value for Plymouth's common stock from approximately $14 to $28 in the case of the PCI 2025 EFA multiple. Here JP Morgan looks at the trading capitalization rate. This is a measure of how much income a property generates relative to its value. Plymouth's implied cap rate is 8.9%, while Stag's is 6.6% and LXP's is 7.1%. A higher cap rate can sometimes indicate higher risk or potential for higher returns. Based on this, they estimated a range of implied per-share equity values for Plymouth's common stock from approximately $14.5 to $28. Finally, under JP Morgan's opinion, they detail a discounted cash flow analysis. This method tries to determine the intrinsic value of a company based on its future cash flows. They used future cash flow projections from 2025 through 2031 and applied discount rates. The analysis indicated a range of implied per-share equity value for their common stock from $21 to $30.5. This is closer to the current merger consideration, suggesting the deal might be reasonable based on this valuation method. The report then directs people on where to find more information, emphasizing the importance of reading the definitive proxy statement carefully. It's a reminder that this is a legal process that requires full disclosure. This part clarifies who might be considered participants in soliciting votes for the merger. It essentially means that the company's directors and officers who have interests in the company are involved in encouraging shareholders to vote. Details about their holdings are available in their SEEK filings. And as is typical in these filings, there is a section called Forward-Looking Statements. This is a crucial disclaimer. It essentially states that any predictions or estimates about the future are just that, predictions. They are based on current knowledge and assumptions, but are subject to various risks and uncertainties. They are not promising to update these statements if things change unless the law requires them to. This entire section is a crucial cover your assets for the company, warning investors that the future is uncertain and things might not turn out as planned. They list risks like the merger agreement being terminated, legal proceedings, failure to get approvals, and the impact on stock price if the deal falls through. The report is signed by Jeffrey E. Witherell, the Chief Executive Officer of Plymouth Industrial REIT, Incorporated. This signifies the official filing and acceptance of the terms and information presented. So, what is my take on all of this Plymouth Industrial REIT? Incorporated seems to be going through a significant transition with this merger. The lawsuits from shareholders highlight a common tension in these deals, ensuring shareholders feel they are getting a fair shake and have all the necessary information. While the company denies these claims, their decision to supplement the disclosures suggests a pragmatic approach to avoid prolonged legal battles. Financially, the analysis done by JP Morgan seems to have landed on valuations that are somewhat in line with the merger price, especially with the discounted cash flow analysis. However, the lower trading multiples compared to peers like Stag and LXP might suggest that the market has viewed Plymouth as a riskier or less valuable entity, which could have played a role in the deal terms being presented. The fact that they are adding supplemental disclosures, even if they believe the claims are meritless, can sometimes be interpreted as a small admission that there was something missing or unclear in the original disclosures. It is a complex situation, and shareholders will need to weigh the supplemental information carefully. The company's future direction hinges on the successful completion of this merger and their ability to integrate or move forward effectively. That is our breakdown of Plymouth Industrial REIT, Incorporated's latest filing. What is your take on these numbers and what they signal for the company's future? Did you find the added disclosures reassuring or concerning? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives into corporate filings. Don't forget to check out our Discord community linked in the description below. Thanks for watching. See you next time.